I think you have to be open to every idea, and starting small is the best way to get in. Like you said, if somebody wants to get into boutique hotels, for example, maybe you do buy a vacation rental in a market that's not as regulated and you just get the hang of that so that you can make your next step into a boutique hotel.
All right, guys, welcome to another episode of The Report. Today, I got a special guest. I got a repeat guest. I got someone who is doing big things in the capital markets, both locally here in San Diego as a real estate investor, but also helping a ton of real estate investors get deaded up for their projects. I got Krystle Simpson. Krystle, welcome back to the show.
Thanks for having me a second time.
Yeah, you were first on episode 11 with your husband, Kenny. Big fan of both of you guys. And that was like literally the first episode that we recorded in this studio over 2 years ago. So thank you.
Cool. Yeah, I'm glad to be back.
Yeah. And I gotta say, I told you when you first came in today, I was inspired to get this office and podcast studio when I went on your guys' podcast like 3 years ago in your old office in Mission Valley. And that's what started this whole vision right here.
I love that. I remember that podcast.
Yes.
Which is it's so funny because so many people come in nervous and
oh
all of
my
that.
gosh, I was so nervous. And I think for the listeners out there listening, it's like, you know, people might think when you do a podcast, it's like, oh, like it must be a natural thing for you personality wise. I'm like, no, it's not. Like podcasting is not natural for most people. And I remember when I did my old podcast, the multifamily takeoff, it was all virtual. And I remember being so nervous for the first one. And then you do like 15, 20 of them. And you're like, okay, that's not bad. And then I remember having Grant Cardone on episode 22 virtual. We didn't even have video. And I was so nervous for that one. And then I was like, okay, you did enough of those virtually. It's not a big deal. And I did my first in-person with you guys as a guest. And I was so nervous. I remember we had to stop the podcast halfway through because my hands were sweating. Literally, hands were sweating on the table.
Yeah.
Yes. Crazy. And so that was my first in-person. And then I started doing more and more in person. I'm like, okay, you get the hang of it. It's not bad. And then I did my first like in person with like a bigger name guest. And it was Tariq El Moussa up at his house in Orange County. Oscar, you were there for that. And I remember being so nervous for that one as well. And now it's like, you know, all these episodes later, I'm like, I'll just get in with whoever and I'll just rip it. And it's not a big deal. But I think the takeaway is, you know, if you're listening to this, it's like nothing at first is going to be easy. Nothing at first is going to be comfortable. But if you do it over and over and over and over and get the reps in, get the at-bats in, anything that's uncomfortable will become easy and comfortable. And no one's born with these skills. A lot of these skills are trained.
You're so right. And it's so true. I think most people just avoid what's uncomfortable. And so they keep themselves from ever getting comfortable by avoiding discomfort.
Yes, 100%. Because I hear a lot of people trying to get in the content game and like, oh, like I don't have the personality for it. It's like a natural born thing. I'm like, no, that is not the case. At least it wasn't for me.
And I always tell people, don't say that about yourself. If you keep telling yourself that story, you're going to believe like, I'm not good at this. I just don't like this. Like, you're good at it and I'm not. You know how to do it. I don't. It's like, yeah, you started off from nothing and look at how successful your podcast and your mastermind and all these things are. I mean, you were the guy shaking and sweating at the table not too long ago.
Yes, 3 years ago.
Know?
Yep, 100%.
Love that.
So, so much to cover here. I want to just first like highlight you and Kenny own a portfolio here in San Diego, a nice real estate portfolio here locally, and you guys have no investors. About $15 million of real estate. Give us a snapshot of like what you guys currently own today.
We pretty much own all multifamily. So that's kind of that's been my bread and butter for the last like 22 years. I've financed a lot of multifamily. We owned a property management company, so we managed multifamily. So that's really, it's just like what I knew and what I've known and what I'm comfortable with. So we own apartments. I would say generally speaking, we own in like sort of C neighborhoods. So I think that's where you get the cash flow. We have one exception, which is a fourplex that we have as vacation rentals in La Jolla Shores. And that is like the highest end building that we own. And it's small, but the rest of our apartments are sort of those like, they call it workforce housing type neighborhoods. And they've done really well for us, but that's probably because we bought like before 2021.
Sure. I'm curious between like the more workforce housing, long-term apartments and the short-term rentals that are a little bit nicer. Which one of those appreciated more in value over the years and which one of those produced more cash flow and income for you guys?
Actually, the multifamily has produced the most cash flow, but a lot of that had to do with buying at a time when prices were lower. And you're right, my debt, like my rate is 3.15 or something. I have a 30 unit building down in National City. It's the rate is so low. So when I come up next for the refi, that's the real question is what is the cash flow after I have to refi?
Do you have to refi it?
Yeah, in a few years. And that's like one of the things that's made me think too over the years. Like a lot of us were locking in for 5 years on these super low rates because also as an investor, you have to basically gauge what flexibility you need with prepays and things. And so if I could turn the time back, of course, I would have done a 7 or a 10-year fixed because my clients who did those are just like, they're cool, they're like chilling.
Yeah.
But that is like a takeaway is we were at the height of the market. That would have been a good time to do longer term debt back then.
And to be honest with you, I mean, even at that time, I mean, rates had historically just continued to go down, continued to go down. And then coming off of 2020, we had a worldwide pandemic and literally the whole world was shut down. Like people couldn't even leave their homes for a period of time. And to think there was no recession that came out of that immediately, at least, and the government printed a lot of money and lowered the interest rates. At that time, I think coming into 2021, a lot of people were like, okay, there was not a big fear of like the rates doubling. That was never in the conversation. And so at the time, I think 5-year fixed or a 5-year term was like a really conservative play.
For sure. And, it's funny you mentioned that because I have clients who are clients and friends of mine that have been investors for 20, 30 years, and they've never seen a market like this. So they've even said it's not ever gone on this long. It maybe there are people who are like, I was here when rates were 18%. So there are some people who were around for that, but just like the how quickly rates went up and how prices haven't really come down commensurate with rates going up. This is like a really funky time to be in
It
the
really
market.
is. It really is. And I feel like from the people that I'm talking to, generally speaking, I feel like most Americans right now have lower liquidity than they did back in 21, 22, 23. And I think the primary function of this is because most Americans, how do they re-up on cash and liquidity is they refinance their primary residence they live in. And so even like a doctor or an attorney that makes good income, 400K, 500K a year, well, those individuals, those families still have expensive mortgages. They have car payments. They have kids in private school. And so they still have to re-up on cash. And so the fact that no one's been able to refinance their homes in quite some time, I think is part of the factor. Also, stock market has been down 10, 12% in the last month. That doesn't bode well. But I think overall, to your point, Krystle, I feel like this last like few years has really been a low-key recession that's not publicly talked about.
For sure. And, it's funny you mentioned about the stock market because I think that was the thing that was kind of propping up the economy is a lot of people that, have corporate jobs or they're busy business owners, they would just invest in the stock market and their portfolio's been doing amazing. I mean, if you look in my neighborhood, there's like construction everywhere. And so it was like we're kind of in this recession where I think the people on the lower middle income bracket were feeling it more. But now the people who make more money, they're feeling it too. I mean, one of the things I was talking about with my banker the other day is that we're all just trying to figure out how to outpace inflation because it's hard to build wealth in today's environment. Like at best, you're just like maintaining the status quo. That's like your best outcome right now. Whereas a lot of people, maybe you're losing value in your stock portfolio, you're losing value in your properties, your income, you're making the same income, but everything's more expensive. So we're really just looking for returns that we can get that are going to outpace inflation so we can build wealth.
Yeah, and I think historically speaking, real estate's been one of those investment vehicles to where it is probably the best hedge against inflation because rents typically go up over time, asset values typically go over time. But I would say the last 3 years, that really hasn't been the case. We've seen negative rent growth in a lot of markets, especially these hotter markets where there's been a lot of development, a lot of new supply entering the market. And so I think a lot of things have definitely slowed down. Where do you see? Because I listened to like Michael Becker a little bit with the Old Capital podcast, and he kind of talks about 2025 as kind of being the year where things kind of level off. It's going to continue to be a grind this year, but he kind of sees as like 26 is going to be a recovery year, 27 will be another recovery year, and he thinks in 2028 a lot of folks are going to look back and maybe regret not buying good opportunities in 2025. What are your thoughts on that sentiment and kind of the forecast over the next few years?
I totally agree with that. It's like the new quote, like as of this year, was survive. It wasn't survive till 25. It's survive 25, get rich in 26.
I like that.
But it's for the multifamily investors because that's kind of like the entry level.
We're
for
gonna make
most
that
people.
the title of this podcast.
I love that.
Say that one more time.
Survive 25, get rich in 26.
I love that. Okay. So, anyways, you were saying.
So a lot of people are thinking about that from a multifamily perspective because that's kind of how you get your feet wet, right? Like you buy your first rental property And you're right, rents are going down. It's making lenders a lot more conservative, appraisers a lot more conservative. So multifamily is kind of that entry level. Well, there were so many we looked at it. Basically, the construction for multifamily is continuing, but then it stops in 26. Pretty much like all the units kind of come to market. There's a lot less construction, new units coming to market after that. We're not going to be able to keep up. So once again, housing shortage, rents going back up, that whole thing. So we're forecasting 26 and 27 to be good years for multifamily, but really that means it's great for every, all real estate for the most part.
Yeah, absolutely. I agree with that. And also, I mean, let's not forget the Federal Reserve has printed 80% of the money supply since 2020. I know a lot of those chips have been off the playing field with the high rate environment, long-term government bonds. I mean, you can get 4.5% risk-free in a CD. And so I think as the rate environment normalizes over these next, 12 months, 18 months, 24 months, I think a lot of that money will start to trickle down. I'm speculating, but I think for us, buying deals, our sentiment has always been, especially the last 3 years, is like, okay, let's buy in good locations. Let's buy in areas to where we can hold these assets for a 10-year time horizon. Because regardless of what happens in the short term, because we're buying in great locations, we know there's going to be an opportune window in the 10-year time horizon to have an opportune exit. So that's kind of been our mindset. But it's going to be interesting to see, and we are seeing some deals start to shake loose right now. I think people that have been holding out for some expectation over the last couple of years, and they're like holding on to 2021 numbers. I think some of those sellers are starting to come to terms now if they need their capital.
Absolutely, you're right, because people think, "Okay, I'll hold through a few more years."
Yes.
And a lot of the people that I'm seeing are people who wanna retire, or maybe the parents passed away, the kids inherited these properties and they don't want them. They just want the cash. They're like, "I don't do real estate. I don't know any of this stuff." So they wanna pass it on. So that's what I'm seeing, and one of the things I was gonna say that is so great about you, Rich, is that you got started when things weren't necessarily easy, and you got into a sector. I mean, for sure with the boutique hotel thing, it's like that is not an easy, thing to tackle. The financing has always been tough, but it's been tougher now that the market's harder for everything. So you had to have the grit to get in there and kinda turn these things around and negotiate seller carries or do these various things like these super creative structures, and that's really what it takes to survive in this market right now. You have to have some grit, and you have to be willing to do some hard work, like roll up your sleeves and do some hard work.
Yeah, and it's funny because us as, real estate investors, we forget because we're in the grind every single day. We're in the trenches building it with the team, and we get used to these conditions. But then I have podcast guests come in and they're like, "Dude, it's not easy right now. It's hard right now. People are contracting." And so I remind that I think it's a good reminder, and I tell the team this every now and then. I'm like, "Guys, like, we should be proud of ourselves that we're growing in a contractionary environment." And so I think when things do improve, and they will improve, we'll be set up. But you're right, it's not easy. I think from the outside looking in, people see real estate investors and like, "Oh, it's easy." I'm like, no, this game is not easy by any means. I mean, the last 2 weeks, 3 weeks, really. I mean, I went through a stretch run where I'm doing 12-hour days in the office grinding, and that's the stuff that people don't see on social media. And I know all these other gamers that are actually doing it as well. They're in there grinding as well.
100%. I mean, that's really what it takes right now. That's what you have to do. So I think that that's like the big thing too. And the other thing is for investors, the reason why most of us, including myself, really, I have to put myself in this bucket because I own another business, so I can't dedicate full time all my time to investing, is that you have to adapt to the market. So the reason why people are feeling so much pain is that you keep trying to do multifamily as an example, but multifamily is not where it's at right now. You need to be comfortable with going into other asset classes that are not feeling the pain as much. Just like the office investors, they had to either recreate their spaces and or go into different asset classes. And so being able to change with the market is really what determines your success.
Why do you think multifamily got so overheated? Because I started off in multifamily, and I still love that asset class, and still own multifamily today. But I noticed in 2021, we bought two of the last multifamily deals in 21. And I saw what these groups were underwriting these deals for. And like a lot of these multifamily deals that had decent locations would have 30, 40 offers on them. And by the time they got to best and final, some of these groups would be overpaying like crazy numbers. And so I kind of saw like it was becoming overheated then. It was getting crazy. And that was about the time I shifted over to the boutique hotel game. But why do you think multifamily got so overheated and so much demand where these other asset classes didn't quite have that?
Again, I think it's your like It's a lot of factors, but one of the biggest things being that that is your stepping stone. So, like, you would find even during this time, like, all of a sudden your real estate broker is now a syndicator, like, now they're syndicating deals. Or, like, the guy who's a doctor, he's joining a group and he's syndicating apartment deals. So, I think
That's so true.
it's partly that, but then also social media, it makes everything move faster. So I feel like the waves of, like any kind of wave, whether it's a trend or we're talking about real estate investing, it's all moving so much faster now because the awareness gets out immediately and the people who can seize opportunities are quick to get to it. And then also, like, the money was flowing. I mean, we had some of our biggest years ever from like 2020 to 2022. Like, those were like massive years. When we were in COVID lockdown, I know it was sad. Some people were stuck at home or couldn't work. In real estate, there was like 3 weeks where we were scared that like we were going to lose everything. But after that, it was like insane, like all out. People making money, people doing deals, appreciation, rents going up like insane percentages every year. So I think that's what happened with the multifamily is everybody gets started there. And then with social media, it's like you see everybody's a real estate guru, right? And usually it's apartments.
Yeah. Yeah, I mean, it got crazy, and I think part of that is like what you just alluded to. There's a lot of like just conversation and hoopla and online educators talking about the same thing. Hey, if you're sitting on the couch right now bagging groceries for a living, like you can become a syndicator and syndicate apartments. But it's funny because we had a deal. This is one of the first deals I did with my old air traffic control partners, but it was a 32-unit building in Indianapolis, C-class, 1960s product, had all the plumbing issues, had all the issues. That thing never cash flowed once while we owned it, but we renovated 50% of the units. We bought it in 2019 for 1.1 and some change. We sold it the first or second month of 2022 to a syndicator, like a newer syndicator, and they came in and paid 3.1 and change. And this asset had all the plumbing issues. We only renovated 50% of the units and never cash flowed the entire time that we had it. And they came in and bought it for 3.1 and change, had investors. And, I wish them nothing but the best, but I think that was a prime example of how crazy the money was. And I think we sold it at a 3.7 cap rate, C-class product in a suburb of Indianapolis in the Midwest. I mean, think about that.
That's insane.
That's a Southern California cap rate
And
by
we've
the
seen
beach.
that. Yeah, we looked at investing outside of California, and I was like, why would I leave? Because cap rates, I mean, how is it that you can go to Texas and buy something at a 4.5 cap, and then you can be in San Diego 15 minutes or 10 minutes from the beach and have the same cap rate? This doesn't make any sense. But to your point, not to age myself, but this is the second cycle I've been through. And so what I saw in the first cycle and what I saw in this cycle so far is that when you get to the height of the market, people are just buying things because it's going to be worth more tomorrow. Like, they literally are like, great, I can increase the rents $200 across the board or $500 or whatever. I can do this whole thing and then I can sell it at a 4 cap. It's worth this much. Like, you just assume that nothing's going to change. And just as an example, I mean, I own apartments, of course. And so just as an example, I have a 2-bedroom, 2-bath in La Mesa that was renting for $2,650. They moved out late last year and I had to re-rent that unit for $2,200. So that's $450 for one unit less an apartment. So rents truly have gone down. And I don't think people were prepared for rents to go down. They're almost going down. They're not going down as fast as they went up, but they're definitely going down faster than they have in years past.
Yeah. And I think people, at least in 21, they just assumed what happened over the previous few years was going to continue to happen. I mean, Phoenix had like record high rent growth for like many years in a row during that time period. And I think they were leading the country in like apartment rent growth around like 11 or 12% a year. And I know some people that got into some deals then, and
It's a boom and bust market.
assuming some very aggressive rent growth, and now their rent growths have been pulling back, negative rent growth. So anyways, I don't know. I wish nothing but the best for that group that bought that indie deal from us. But I'm like looking back, I'm like, man, we got out at the right time. But also I think it's a reminder that what goes up definitely comes down as well.
And that we're not all experts at real estate.
We're not all
you know
experts,
what I mean?
no.
Yeah.
And you got to stay true to your underwriting, your fundamentals. I think one of the best ways to do that is to, always have conservative assumptions in terms of rent growth or ADR growth if it's a hotel. But even more importantly is be conservative with your exit cap rate assumptions. And I think that's one of the easiest ways to be conservative, and just assume the cap rates are going to soften when you go to exit or when you go to refi the asset.
And that's one of the things we did. I mean, early on, I have a couple clients who are very proactive. They've already been through it before, so they know what's happening. So we would have our clients, they would come in the office and we'd look at their real estate portfolio. We'd size every single one of them and run them at different cap rates and different interest rates for the refis just to see where they were at. And it was basically a decision of like, do I sell the asset now or do I keep it? And so like we're running those scenarios. And that's what I think any sort of, astute investor would do is run these scenarios, like you said, like best, middle, worst case on every scenario to say, can I live with worst case? Can we get through a worst case scenario?
And that's how I like to make most decisions. It's like, okay, what's the worst possible outcome? And are we okay with the worst possible outcome? The answer is yes, and there's a lot of upside. Then it's not going to require too much time. Then that's probably something or an opportunity that I'm going to definitely be interested in. I'm curious with what you're seeing right now, because obviously you're in the capital markets. You do a lot of commercial lending. Are you seeing a lot of loans coming due for maturity, like even perm loans?
Yeah, a lot of loans are rolling over, but so most of our loans, let's say even if somebody did a 5-year fix, it could have a 10, 15, or even 30-year term. So it would just adjust up to the margin plus the index. So that's what we're seeing, and I'm having so many of these conversations. I feel like I'm having more conversations about refinancing than people are definitely not refinancing, because if rates are on the way down, it's kind of like this middle balance where you're like, maybe I just float the rate for a little while and refinance when the time is right. Because with commercial loans, of course, you're dealing with more fees. It's not like I quickly refi my house. I can do a
Yeah.
no cost loan, blah,
Yeah,
blah.
6-month extension could cost you half a point, even a full point
For sure.
for 6 months.
Yes.
Some of these smaller hard money lenders might be 2 points.
Yeah, it's
Yeah.
insane. It's insane. So I will say I feel the people that have hard money loans had less flexibility with their investors than the banks, because the banks were definitely more of the mind to work it out with you. They didn't want to have any bad loans on their books. So they wanted to work it out. So we've had clients call us and we've worked out waiving prepays. We've worked out extending loans, even if they weren't quite debt servicing. So banks have been a lot more willing to work with people just to get through this period. I think they learned from the last cycle where they were a lot more hard-nosed about those things and they took some buildings back, that they actually just want you to keep the building
They
and
don't
they
wanna
don't
be
want
operators.
it.
Yeah,
Yeah,
yeah, yeah.
yeah,
And I feel that's the case with a lot of these bridge lenders as well. I feel like as long as you're, you have a good relationship with them, you're paying your debt service payments on time, I feel like, for the most part, they wanna work with you. However, I will say we bought a deal in December of 23, that was directly from our bridge lender, and they had just repossessed it from their borrower who developed it. And same thing, to your point, they came to me in November and they said, "Hey, we gotta get this off our books by the end of the year. We're not hotel operators. We don't want this on our books." They said, "We think you guys would be the perfect buyer for it." And they even financed it to a 0% interest for 6 months. They did a 2-year no, and they gave it to us for a discount, because these lenders typically, for the listeners out there listening, a lot of these bridge lenders are typically capping around 65% of the appraised or the ARV. And so when they take an asset back, they can typically sell it for a discount and still make a little bit of money. So that was kind of the opportunity for us. But I've been telling people, I'm like, one of the best opportunities to find deals right now is go talk to all of these commercial bridge lenders that are lending on commercial real estate, multiple asset classes in all 50 states. Some of these groups are big, and like this particular group is a REIT. They lend in all 50 states. And so if you get in with them and you have a good relationship with them, they have deals that go bad, and they know before these deals go bad, what's coming due. And so that is an opportunity for some deal flow as well.
for sure. No, that's a good point, because a lot of people don't know how to get a hold of like that department of the lenders. I had so many clients that were going to like the auction, and buying properties. So they kind of have contacts at certain banks even now where, they got those properties. But to your point, I think like, because the idea of off market, so it used to be that off market was you got a deal, right? Like it was a deal. Nowadays, off market is like some pie in the sky price, I'll sell if I get this number. So how else do you get a deal? Like you said, if you go directly to the lenders that are taking these things back, that's a great way for them to offload these things pretty easy and for you to get an opportunity with some upside.
Yeah, absolutely. I think that's big. And I think the best way to get in with some of these lenders is like go get a little bit of like, go do a deal in whatever asset class that is, get a little bit of experience. Once you do that first deal, if you're new, then you can go to these bridge lenders and say, "Hey, I just closed this deal. We closed in a relatively quick time horizon. We have some hot money that needs to go to work. What do you have that might fit our search criteria? And I think just being able to communicate it, being able to spit the lingo is so big in this space. I mean, talking to lenders, brokers, people that have deals, even other sellers, just being able to like present yourself from a position of strength and give the broker the confidence that should they have an off-market opportunity or a good opportunity, that you have the ability to take that deal to the finish line.
100%. I mean, honestly, the probability of execution is probably one of the biggest things. I mean, if you think about even a real estate broker who has a book of business, they're doing business, who are they calling first? They're calling the guy they know is going to perform. They're not calling the guy who's wishy-washy, who doesn't have the money, who's just going to like try and figure it out. They're going to go to the guy who can just get it done.
Yes. Our last deal, we just closed in San Clemente. We closed it start to finish, due diligence, funding, everything in 37 days, which if you're listening to this right now, like most commercial deals are probably 60 to 90 days start to finish. So we did it in 37. And the reason I pushed it, I told the team, like, let's just move really quick, is because I want to be able to position that or leverage that last transaction to other brokers, other lenders in the marketplace and say, hey, we just closed the last one in 37 days. We're super easy to work with. And as I think more opportunities will shake loose this year, I think that will bode well for us.
So smart. So smart. I was saying to you too offline is like, I think what I'm seeing with the boutique hotels too is a lot of just tired landlords. Hotels, they take effort to run. And so a lot of these get like, run down, and they don't have the money and they don't want to try to fix these things up. So there's just so much ripe opportunity for people who owned these things for forever, and they're like, I'm done. I don't want to do this work anymore.
And I think for those sellers, like it's a big pain point for them, right? And so like that asset is a headache, it's a nightmare. And so, okay, well, what's the best way to solve that pain point is to present something that's really relatively quick. And I think that's where you can strike the opportunities and maybe get potential good deals out there in the marketplace. Okay, so I want to switch gears here a little bit and talk about, we mentioned at the top of the show how right now, like the people that are winning the game are getting creative. They're in here grinding. They're not taking no for an answer, and they're figuring out ways to push loans through, whether it's creative financing, seller financing, bridge loans, seconds, lines of credits. Like there's ways to still get deals done, and you just got to get creative in a lot of these scenarios. So I wanted to ask you, like, lines of credits, second mortgages, have those been a pretty popular thing over the last year and a half?
Oh, definitely. That's because nobody wants to touch the rate, right? Whether it's your house or your investment property, nobody wants to touch the rate. Now, because Kenny does the residential, I do the commercial, we're usually strategizing internally over which is the best way to go. And so like I say it all the time, I hate to take loans away from myself, but a lot of times I'm like, hey, you either need to go to Kenny for the line of credit, or, even if it's a purchase, you need to get the seller financing. And so we just try to guide people on what they need to do, knowing that they're going to come back to us later. On the commercial side, with the lines of credit, I've done a lot of them. They're hard to find because most banks don't do them. Most banks don't want to be in second position. The other thing is you got to check, but there's usually a covenant in your loan docs that says you cannot get secondary financing. Like you could technically be in default.
And they could call the loan due, technically.
Yeah, it's a no-no, truthfully. Some banks right now.
Have you ever seen that happen, though?
I've seen it happen twice
Really?
in 22 years.
And what was the scenario there?
It was so long ago, I don't even remember. It was literally like 2004 or something, a couple years during that time. I have not seen it now because, again, banks, they go through these audits. They don't want to have, quote unquote, bad loans on their books. So if you're paying, generally speaking, they want to work with you. Now, some lenders, let's say that they're in trouble, I've been seeing more is they don't like these rates, right? Like they're like, we got to get a higher rate. I don't want this 3% rate floating in my portfolio. You got to pay it off. So they might call the note for that, but I have not seen it yet, knock on wood. And I've had like a lot of clients who have taken that chance because they're like, I don't want to refi. I have a prepay or it's coming up. I'll just refi in a few years. So it's like for most people, that's essentially what they're doing. And we have a couple lenders who are willing to do the seconds. They just want to make sure you're going to use the money. That's like the biggest thing. They're like, I'm not giving you the line so you don't draw on it. You need to draw on that line,
Yeah. No, that makes sense. What I'm curious, what kind of, like, how expensive is that market or the money for like a second or like a line of credit?
Prime +1 usually. Yeah.
Okay. Yeah, it's funny because we're talking about some of these loans potentially could be called due if you have a second. Pace Morby was on the show recently, and he does all this subject to stuff. And I was asking him, like, do they ever like call these notes due? Like, what are the lenders? How do they look at it? And he's like, it never happens.
Yeah, it's rare. It's really rare. Like I said, they don't want bad loans because it causes problems for their audits. So that's like the good thing about it. Now you might get like blacklisted from some of these small lenders who like hold a grudge. That has happened to me before. I got a
Really?
second. Yes.
What happened?
I had an apartment building and we got a second. We got a line of credit against this. And this was probably like 2016. And anyways, the lender found out it was a small bank and they like got mad at me and they just made it tough for me to do loans with them ever like after that. Now, luckily they weren't like super competitive and there was always more options out there, but they definitely held it against me.
Really? What did they say?
So my banker is also at the time, when he was there, he's somewhere else now, but we're friends. So he'd be like, "Hey, Krystle, my boss is not really happy about that, and you sort of got on the blacklist." I had another lender that has no prepay, and you'd get on the blacklist if you paid off the loan within 2 years. So there are like certain like chief credit officers who just hold a grudge. Like we're talking mom and pop businesses here. Like even though it's a bank, these are tiny little banks. So they just like have the time to do this stuff. Like if you go to like a bigger bank that's doing a lot of volume, they don't have time for this stuff. But if you're going to small local community banks, which is probably what a lot of your people are doing with the boutique hotels and things like that,
Yeah, on the perm side for sure.
it's very relationship based.
Yeah, yeah, very relationship based. Yeah, I feel like perm debt for boutique hotels is going to be a lot of like regional banks, community banks. And I mean, you know this better than myself, but I feel like the location of the asset, it matters so much. Like you might buy a deal that's more rural and only have like one or two banks that even want to look at it. Where like the San Clemente deal that we just acquired, there was like a whole line of lenders that wanted to fund it, a whole line of them, and some of them were like, "Hey, we can fund this in 7 days." And so, and the only thing difference was the location, really.
The location really matters. Like, honestly, even in San Diego, I've had it where clients had like a boutique hotel in Escondido, for example. They're like, yeah, no, thank you. But we financed them in PB, no problem, OB. And it is because still some lenders want flagged hotels, even though like I really think that's kind of not a thing. Like, I think the boutique hotels are where it's at, but lenders are always last to catch up, right? So now they're finally starting to get it. But you're right. They have to be in like absolute insane locations next to the beach or a lake is preferable.
Yeah. I'm curious, like with the bridge lenders right now, are you seeing a tick up in, bad debt on their books and deals that might be going bad in this environment versus 3-4 years ago overall?
I have not heard of a lot of deals going bad, but I have heard my lenders having to work with a lot more clients, like especially so I have one private money lender we do a lot of business with, and he was doing construction for us. And for example, like I called him on another little construction deal and he's like, "I'm not doing construction anymore. I'm done. Every problem loan I have in my portfolio is construction."
Ground
So,
up stuff?
yeah,
Yeah.
yeah. So, construction's definitely having like some of that bridge stuff. Like you're saying, if you're going to reposition a property, get the tenants out, they're having to work with people, especially in San Diego, because obviously the landlord tenant laws and tenants are just a lot more informed now. They make it difficult for you. The city, if you didn't pull permits and then you get caught, like all those things are happening. And so I haven't seen many lenders have to take anything back, but they've definitely had to work with people a lot more and extend loans
Yeah,
out
totally.
far beyond their comfort.
Totally. And you get stopped by the city or it's I think that's the biggest risk to a lot of these projects is when you have no income coming in, you're building, developing, you're doing a full reno, contractors can disappear, the city can stop you, you can go over timeline, there can be a lot of change orders, you can run out of money. There's a lot of risk involved. I'm curious with those construction loans, like ground up development. I haven't really done much of it other than, some personal ADUs of mine, but I'm curious, a lot of those lenders, those loans, are they charging the interest monthly or do they just wrap it into the payoff?
So they do what we call like a built-in interest reserve. So technically they make the payments every month, but they build it in to the loan. So they just keep their separate reserve to make the payments during the construction term. And most of them are
So the you're saying the developer or the borrower would wire into escrow at closing
it's part of the
the
loan.
payments?
So let's say that if you come to me and you have a project, I'm going to tell you, I can do 70 to 75% loan to cost. including your interest reserve. So that has to be like part of your construction budget is your interest reserve and your contingency and all those things. It's just funded as part of the
And
loan.
they'll hold the contingency money, basically, the lender
Yes,
will in an
they
escrow
hold it.
account?
Yeah, and they don't give it to you until you get later in the project usually because they don't want you to run out too
Yeah.
early.
We the bridge lender we work with a lot of our hotel projects, they do a similar thing. So let's just say like one of our latest projects was a $2.2 million reno. And so most of these bridge lenders will finance, let's just say 65% loan to cost. So instead of financing just the 65% of the 2.2, they are financing that, but our 35% of that reno, we wire in to escrow at closing, and then the lender will hold that in a escrow reserve account.
Oh,
The
interesting.
entire 2.2. Even though 35% of that is our money, they hold it. And so that's the entire renovation budget. It's there. And then we draw against it as certain stages of the renovation are completed.
Interesting. I haven't seen that structure, but that's also like the difference between a private lender, a more private lender, and like a bank. Like the way bank construction loans are done, it's like they do them all the same. Everybody's just the same. And I haven't done too much of the private money construction. I have done some.
Yeah. It's smart on their end because they know, hey, there's no risk of them running out of money to do the full renovation.
Yes, and I saw that a couple years ago, even with multifamily. There was a couple small banks that did more like bridgey type stuff. And like the small banks, they would want to hold your rehab dollars and distribute because they just felt like there was so much risk to the project. It's really just a protection against the risk. Now, what a lot of our banks are doing too, which people don't love, is they want you to have a certain deposit relationship with them if they're funding the construction loan. And frankly, it's because they want access to those dollars should things go awry. Like it's basically like they won't position it
That's
to you
the
this
reason
way.
why.
It's extra contingency money.
Mm.
That's what it is. And it's written in the
I
docs.
thought it was just because there was more money they could go lend out.
So for permanent debt, yes. But for construction lenders, it's all about mitigating risk. And in the docs, you sign that they have access to use those monies if you run out of construction funds.
Interesting.
Yeah.
Hey guys, real quick, I just wanted to personally thank you for listening to this podcast. It means the world to me. The only way this show grows is by word of mouth. If there's anyone in your circle that could benefit from this podcast, it would mean the world to me if you could share it with them via text or maybe on your Instagram story. And I'll be sure to keep an eye out on my Instagram for shares so I can reshare you on my Instagram story. Again, thank you so much for listening, and it means the world to me. Now back to the show. Yeah, I mean, I thought this model, I think this model is good for the private bridge lenders, because it's like, if they're only lending, they're capping themselves at like 65% all in on the after repair value or the stabilized value of the project. And then they keep the entire reno budget in an account which they hold. That the risk of that deal going bad is dramatically decreased.
Exactly. Yeah. I mean, and really all lenders is they just
Risk
mitigate
mitigation.
risk.
Yeah.
Yeah, all the time. That's every single lender. So, but to your point, the hard money industry has been booming since interest rates have gone up, right?
Yeah, I know, because perm debt's like 7.5, and you can get bridge at like not much more. It makes more sense to get bridge, and you get financing for construction and all that sort of stuff. And
We have some bridges
a lot
7.25
quicker
now.
A lot quicker to close.
Yeah, it's quicker to close. It's not all the paperwork, all the BS that everybody hates. Because I always say this, I've never run into anybody who enjoys the loan process. So it's like if that spread is that thin between bank rates and private money rates, some people are just like, screw it. Like I don't have to give tax returns and bank statements, all this crap. And you can close quickly. It's no headaches, no risk of it not getting approved. It's just easier to go that route a lot of times.
Agreed. That's why I love lenders that are more relationship based. They're going to look at maybe the experience of the sponsor. They're going to look at the deal. How does the deal pencil? But all the other stuff, everything else that comes with getting a loan done, the tax returns, the bank statements. They want to know your blood type, your spinal fluid, like literally the A to Z. It's just like, okay, then you give them everything, and then they want a whole nother list, and it just goes on and on and on. And then they want to see all the operating agreements of all the LLCs and all this. That's a lot. But I will say, it's part of the game sometimes, and sometimes you got to do what it takes to get some of these loans done. So I don't mind doing it. I will say it is a good feeling, though, when regardless if it's, a conforming loan like a bank and you got to go through all the hoops, or even a bridge loan, it does feel good to get that approval and be like, okay, appraisal came back clean. You got the approval, they're gonna do the deal, that feels good, and then when it funds, you're like, "Oh my gosh," like, it just feels good. I'm almost addicted to that feeling.
Yes. Well, it's so funny because we do loans for a living, and Kenny would probably never admit this to you, but, like, when we even, like, bought a house, anytime we do loans, he is, like, he's so worried that some, like it's like when you're driving on the freeway and you see a cop driving next to you, and you're just like you get weird, right? You're just like, "Oh, shit." Like, it's the same thing with even us doing we do financing all day, every day, and it's like we just imagine this, like, thing coming out of nowhere and just, like, blowing up the whole deal. It's terrifying, so when you're done, you're like you feel like it's, like, a huge victory.
Oh, totally, and there's so many things that can go wrong. I mean, you could have the wrong appraiser, and the appraisal comes back way off, like, there's so many things that can go wrong, and, that's why it always feels good to get these things done, but also the takeaway is, like, even if you get a no, it's like, if you're listening to this podcast right now, like, if you get a no, you should not stop. You can get 100 no's and then get one yes, and all that matters is that one yes. There's always someone out there that can help you get something done. You might have to get creative. You might have to do something that's not, the mainstream way of getting things done, but there's always a way to get things done.
And I have clients that are just the same. Like, I have certain people that come to me, obviously, that they're retired, they don't really have any other income, they just have this one building, and so, like you said, a lot of lenders will turn them away because 'cause they're like, I don't see how this debt covers here, like the global," and, we end up getting those deals done, so they really truly are out there, but I have literally like, people say, "How do you find lenders?" Sometimes I do the same thing you have to do. I literally go look, and I call up every lender I know and try to get to the people that are doing commercial loans, but I have so many stories of people who, like, didn't have the income, didn't have the qualifications, and they're still getting the deal done. But it's just gonna take you a while, and you're gonna have to jump through a lot of hoops and make a lot of phone calls, but you are absolutely right. It's not worth stopping.
Yeah, no, absolutely. So question for you. So if someone's listening to this right now and they're like, "Hey, I wanna get, some commercial lending for, whatever asset class it might be." Maybe it's multifamily, maybe it's a boutique hotel, and this is their first deal. What kind of things can they do to present to, a mortgage broker like yourself or a lender, to position them in a place of strength, even though they might have never done a commercial deal before?
I would say to start, and you're right, like, in this market, lenders are kind of funny. They're like, "Great, I have all these newbies coming to me." I have these conversations with my bankers even now, but one of the things that I would have is, like, the first thing I ask for is your personal financial statement, and so many people have never done that, aren't even really sure what that is. It's not a loan application, it's definitely different, so I would have your personal financial statement and have a bio that just gives any kind of background, and it can be the dumbest stuff. I mean, for some people, like, the logical kind of, like, lateral move for hospitality, for example, or for the boutique hotels is that you worked in hospitality, like, you worked at a hotel or you did something. I've had people draw up some very weird parallels, but, you know, you're gonna wanna have a bio because everybody wants to know the story, and it might just be something to throw in the file. But there are a lot of lenders now who are willing to take a chance. But I would say the hardest part is most investors don't have a lot of money to start, right? So they're, like, tight on cash. So I would say also, if you're new to this, I would be prepared to maybe try to get a partner if you're not qualifying on your own, because it's the first deal. I always tell people this, it's like that first deal is so hard to get done. Nobody wants to take a risk on you. You don't have the net worth,
Yeah,
like all these things.
so hard, yeah.
Partner.
Yes.
That's the only way to really get it done upfront, unless you've got, like, a really high-paying job, you have, like, assets from somewhere, maybe you were already invested in the stock market, it's done really well, so you have liquidity. There are those, but most, like, of the average people getting into this just have, like, regular jobs, they worked really hard to save, and after their down payment, they have, like, nothing left.
Yes, 100%. And nothing wrong with partnering. Like, I remember my first couple, like, agency loans, I didn't have the net worth to qualify, so I remember bringing in, a loan guarantor and literally giving that person 10% of the deal to, come into the operating agreement and sign as the loan guarantor because they had the net worth. And so now I don't need to do that for a lot of the deals that we do. I can be the sole guarantor, but because I was willing to do that back then, that led me to another deal and then another deal, another deal. And now 12, 13, 14 deals later, I don't need to bring someone in. But also, I think another thing that you can do is, maybe you don't have the experience or the track record, but, like, what does your team have? So, like, maybe you're working with a property manager that has a ton of experience managing multifamily in that market or hotels in that market. And so you can leverage that experience.
100%. No, your team is really important.
Yeah. What are your thoughts on, maybe doing, if it's the first one, just doing a smaller deal. Like maybe it's on the multifamily side, and maybe do a smaller deal that's easier for you to get the lending, just to kind of get that on your resume.
I totally think that's the best way to get started. I mean, we got started with house, so and then we rolled that into apartments with partners for the first, like, 3 deals, and then we went on our own. So I think you just get started wherever you want. Like, in that example, we wanted to start with, like, a 3 or 4 unit, but we just there was nothing in our budget, so we were like, "Screw it, we're just gonna buy a house." We bought a house, and that's how we got started. So I think you have to be open to every idea, and starting small is the best way to get in. Like you said, if somebody wants to get into boutique hotels, for example, maybe you do buy a vacation rental in a market that's not as regulated, and you just get the hang of that so that you can make your next step into a boutique hotel.
Yeah, that's not a bad deal. Also, I think, and I'd love to hear your thoughts on this. My first 2 deals were on the commercial side, but very small, like loan amounts. So 11 units in Cincinnati for 350,000, which is insane. In the loan amount, there was a 75% loan. So the loan on that thing was probably just over 275, 280. And so again, easy for the lender to kind of wrap their heads around, right? And at the time I had a W-2, and so I had decent income to show. But also, like, on the schedule of real estate owned, that's good on my track record to go get more commercial loans, because, like, hey, I have an 11 unit apartment building, and the one shortly after that was 32 units, but only 1.1 million, and that loan was like around 850, 900. Very easy to wrap your head around from a lender perspective, but again, 32 units, 11 units, that looks really good on my schedule of real estate owned.
100%, and those numbers are so funny to hear living in San Diego.
It's
So I'm
crazy,
like,
right?
"Wow, that's insane."
Yeah,
1
30's
unit costs, 350,000.
30's a door.
Yeah, yeah, it's
I'm like, that's
crazy.
insane.
It's crazy. Yes, I would say that anywhere you can buy and get started and have some kind of experience on your real estate schedule is huge. It's kind of funny though, in lending, most lenders are so snobby these days. They don't even want to touch loans under $1 million. So it's like the financing for those first small deals is not as straightforward. So I like for example, I see some people buying and they call me. They're like, "Hey, I'm running the numbers." They're running their numbers at the $1 million plus loan amount, or even for some lenders, 2 million plus. And I'm like, no, no, no. I mean, you're going smaller, the rate's going to be higher, because there's fewer of those lenders. They're out there though. Like I said, like you said, don't give up, but they're just like harder to find. And you're going to pay a little bit of a premium for having like a low rate, because bankers don't really like working, right? So it's the same amount of work for a $350,000 loan as it is for a $2.5 million loan.
Yes, I know. And so you gotta think about it, is that worth their time, especially if they have all this other opportunity out there? Yeah, I'm like thinking about that kind of a loan amount now. That's crazy. So curious, for you, do you feel like when you see a lot of these, obviously bridge, you're seeing perm financing and then different loan amounts? Because something that I really want to do is I want to do a portfolio loan. And I want to refi all the hotels in our fund into a portfolio loan at some point. So my goal, big picture, is to put 10 boutique hotels into this fund, and then I'm going to close it. And then at some point, I want to refi, hopefully when the rate environment is much cheaper than it is today. So let's just say 27, 28, around that time period, to refi all 10 of them into a portfolio loan. What does that kind of look like as a borrower? What are the pros of doing a portfolio loan? What are some of the things to look out for? Maybe what are some of the downsides?
Yeah, I think the biggest downside is really if you wanna negotiate partial releases within that loan, because not a lot of lenders like doing that. So you may have to get, like, a different creative
How
structure.
come they don't like that?
It's just more work for them, frankly, and then you've gotta negotiate the docs. It's, like, not part of their, like, Laser Pro docs, so then you've gotta get, like, attorneys to draw those. You're gonna probably wanna have your attorney review it to make sure it's good, because I've actually seen people that have had trouble with releases, small banks that weren't really
Mhm.
quite set up. So I would say that's your biggest risk, but outside of that, I would say, I mean, that's a really good idea, theoretically, because, what you really wanna do is just focus on having, like, as strong of a net worth and liquidity that you can have between you and your partners, or whoever's willing to be a guarantor with you, because there are some banks that are giving, like, smoking pricing on boutique hotels right now, but they're doing it for strong clients, and I'm starting to see more and more, like, boutique hotel operators that have a portfolio of hotels like you're talking about, and for the strong borrowers, like, I just quoted somebody 5.95% on, like, a
Wow,
a boutique
that's
hotel
great.
in Catalina Island. Yeah.
Wow.
So, but that's a bank because he's a strong guy. He owns several other boutique hotels in San Diego. It's like he's the kind of client that they want. So if you have like these well-located things, like boutique hotels, you're just like really well positioned to have a bank like give you a really good offer on that.
By the way, I love Catalina. I go out there all the time. I would love to own a small hotel out there. That's pretty cool. Okay, so what about in terms of like pricing, leverage? I mean, do the banks look at these portfolios as like, okay, that's a little bit less risk because everything's kind of diversified, and ideally they're all stabilized. But because of that, are you able to get, and the loan amount's a little bit larger, which I'm sure they like. But are you able to get better pricing, generally speaking, for a portfolio?
Not necessarily, no, and for some banks, like, for a long time, honestly, a lot of lenders didn't wanna lend on hotels because they were like, "We have such a high concentration on hotels right now." So every bank is really looking at concentration, so it's not necessarily a good
When you
thing to
say concentration, like location, or
know
just like
asset
relative
class,
to like their entire portfolio?
entire portfolio,
Got it.
like, we
Yeah.
have X amount in loans to like, for
To
hospitality.
allocate.
Yeah,
Got it. Now, with a portfolio, you can attract like CMBS and like other products, yeah? So
100%.
it's not always gonna be it probably won't be a regional bank, or
Not
it could
necess
be.
it could be, and then CMBS, obviously, you've got, like, these crazy yield maintenance and defeasance prepays, so it does limit your flexibility. Some of them can be really sophisticated products, so they could be swaps, right? And you can
What's
kinda
a
like
swap?
a swap is like a certain type of index, and it's really like I've done only a few swap loans ever, but basically it becomes this investment vehicle. Like, for example, you could move the swap onto a different property. It's essentially a loan, but it's like you bought like an index essentially, and you can basically use it to like make money or you could like lose money on it. And so that is like much more of a sophisticated product that like as an example, the last loan that I did that was a swap, the lender had was it was mandatory that we got on a call with the borrower and they did a presentation on the swap to make sure they fully understood what they were getting into because it is more complicated. But those loans are a balloon because, like I said, if you're buying an index, let's say you buy the 10-year, you're buying that 10-year note essentially. And so it's due in 10 years. It's like defeasance essentially. Like basically you're paying the interest no matter when you pay off. But in a rate environment where rates are going down, you can use it to make money. And then again, you could say, hey, I want to sell this property in our portfolio, but I'm going to buy this asset. So they would just underwrite that asset and allocate that debt over there, and you would then pay
Mm,
off that hotel.
that's pretty cool.
Yeah.
I like that. So you're just swapping money around
Yes.
at that point. Can you clarify what yield maintenance is? Because I think for a lot of real estate investors, I think you see it more on the multifamily side. We saw a lot of like agency loans have yield maintenance, and that was killing a lot of deals back in like 2021. But what is yield maintenance?
It's a very complicated prepayment structure, and the lenders internally have their own formula. But essentially, what I tell clients is if you're in a rate environment where rates are going up, it's okay because your yield maintenance is going to be like really small because they can turn around and lend that money out at a higher interest rate. But if you're in an interest rate environment where rates are going down, you're going to get killed. It's not going to make sense. And people ask me all the time, can I negotiate? No, Fannie Mae and Freddie Mac do not negotiate prepays. Why would they do that? They don't have to. So if the rates have gone down and you need to pay off, that's where you end up having these massive prepays, and probably why the deals were falling apart over those things is like sellers are like, I'm not paying this. You have to assume the loan, and then if they're not at terms they like, they end up losing buyers or just keeping the deal.
Yeah, there were a lot of deals in 2021, like on the multifamily side, that would have a yield maintenance, and the prepayment would be, a million, 1.5 million prepayment penalty. And so the only way around it, like you said, would be to assume the note, but it would be like a 5.5% note in a rate environment that was like 275, and that was what was killing these deals. But from the seller's perspective, they're like, well, my asset has appreciated 35% in the last 2.5 years. I want to capture that upside, but then with the prepayment, it just didn't make sense.
Yeah, on the flip side, I had a lot of clients who said it was worth it to pay the yield maintenance prepays when interest rates were going down. because they could lock it in, and it was like, "I'm gonna recapture this within so many years." Like, some of the big syndicators that have been in town for a long time, they paid millions of dollars in yield maintenance prepays to lock in on lower debt. And that they just that was it's all a numbers game, right? Like, is it worth it for this? How long is it gonna take for me to recoup? All of that. But you're right. Like, when rates are going down, you don't wanna pay off, because you're gonna have a significant prepay. And as you get closer to the end of the term, it's less, right? Because if you're in year 2 of a 10-year fixed, that's gonna be painful. It just doesn't make any sense. But if you're in year 8 of a 10-year, it might make sense.
Yeah, totally. And then, obviously fix is always an option. I mean, what are you suggesting to investors these days, clients of yours, in terms of prepayment? Because I'm locking in debt now. I'm thinking, okay, the rate environment in 2, 3 years, 3 years, 4 years time likely is going to be much lower than it is today. At least I hope it would be. And so I want to have the flexibility to refi again in 2 or 3 years if needed. So what are you suggesting other investors do that are locking in perm debt right now with prepayment penalties?
Basically, well, I'm actually saying try to get little to no prepay and get the shortest term fixed you
And
can.
even pay a premium for that if needed.
You can. So, for example, I even have some lenders where they have only a 5-year fix, for example. I'm always asking about a 3-year. People ask about adjustables. Of course, now would be the best time to be an adjustable, but they price them up. So, like, let's say
What do you
that
mean?
let's say the market rate right now is around 6 and a quarter.
Okay.
For some reason, the adjustable's like 7 and a quarter or something. So it's
You'll
like
pay a spread.
it's ridiculous. It's so dumb. And anyways, so that's why the like monthly adjustable's not really making sense because they price it up so much more. So then you want to go to a 3-year. Well, not all lenders have a
And
3-year.
real quick on the adjustable, like being priced up today, it's funny because 4 or 5 years ago, adjustables would be cheaper,
So cheap. Yes.
right? But then you'd have the
Yes.
risk of them going up. And so now
Correct.
lenders they're anticipating rates are going to go down over time. And so
Yes.
that's why they want a little bit more now in order to account for that.
Correct.
Got it.
Yeah. So
Okay.
there's a lot of spread built in there, even though, as you know, I think it's been reported that the banks have been making a lot of money the last few years. But they definitely have. I feel like their spreads are a little thick too right now. The spreads could come down because we got to this level like late last year, and I saw rates in the fives, like 5 3/4, 5.875, and we're still around like 6 1/4 for most lenders. Some are around 6. And you can get in the fives now again, but it's like sub 50% loan to value. Some of them yield maintenance. So what we're really guiding clients to do is just little to no prepay. And some of our lenders are pricing up. Like I have one lender that says, okay, you add like 0.5% to the rate for just a prepay in the first year. Great. Awesome. We have some lenders with no prepay. And then we have other ones where you can buy it down, where you're like paying 0.5 point, let's say, or like a quarter to the spread on the rate. So we're always asking those questions because I know everybody's going to want to refi.
Yeah. Where do you see opportunity right now? I mean, I know you and Kenny invest. You guys don't have investors, and you guys are building your own portfolio, long-term portfolio. Where do you see opportunity as we navigate through 25 and 26?
Well, it's kind of funny, and I'm not just tooting your horn, Rich, because quite frankly, I think like the first it was like multifamily, and then multifamily got too like saturated. So then it was like, how do you make money on multifamily? Multifamily, well, you add ADUs, and so like I'm doing construction loans for people who are adding like 12 ADUs, 18 ADUs, like all this crazy stuff. But now that regulation's coming down the pipe, and I don't think you're going to be able to do that anymore. So now it's like, what's the next best thing? I truly do think hospitality is where it's at, like the boutique hotels.
Krystle,
Um,
don't gas me up too
I
much.
know,
Come
I'm
on.
sorry. Industrial has remained really strong. Like, there is a definite need for small industrial buildings. Like, if there was like an article maybe a month or so ago, but I will say that there's a lot of like mega industrial now. There's all that class A, like beautiful, brand new stuff all over California. But there is a need for the mom and pop, like industrial type building. And the clients and friends that I have that do industrial, I mean, they're like flying in the private jet now. I mean, and they've been doing this like 5 7 years or whatever. Like they've been doing really well with that sector. So I would say that that's a really strong place to be. Retail is actually still quite strong, I would say. Depending though, like you really need to know your stuff. I'm going to give you a complete example. Like up in Oceanside, for example, vacancy is higher right now for apartments because there are so many new units that are coming online. So naturally, I would say I'm probably a little gun shy in Oceanside because they're a little they need some time to absorb those units. But what would make sense? Retail. Those people need to shop somewhere. So I think in those markets, like where there's always an opportunity somewhere is kind of the point. So it's like boutique hotels, industrial. I think strategic retail could be really good. Just depending, in places that are overbuilt, I think you're better off going retail versus apartments.
Yeah. Yeah, I mean, I think a lot of this is really just looking like taking a step back and looking at everything from a macro perspective and say, okay, with technology evolving, with demographic shifts that are like evolving, like things are moving relatively quickly. Regulatory environments are changing. But like look at how it's going to affect certain asset classes over the next 3 to 5 years. And this is all calculated risk. Also, where our cap rates right now with all these different asset classes, we just talked about multifamily at the top of the show being a little bit overheated, cap rates are a little bit low. And so, maybe right now is not the best time for multifamily, but what other asset classes are going to benefit from all the things that we just alluded to, and the reason I'm bullish on boutique hotels right now is because I know Airbnb is going away in a lot of markets. And I know there's tens of thousands of Airbnb investors out there that are going to be looking for that next thing. And if you can operate a few Airbnbs, you can operate a boutique hotel. And so I think that asset class is going to benefit from it. But there's other asset classes out there that are going to benefit from a lot of this stuff. I mean, you mentioned industrial, the days of, look at all these shopping malls they're going away right now. I mean, in San Diego, we got UTC, Fashion Valley. A lot of these other malls are shutting down. We saw Horton Plaza. And so, as that happens, I think online business is going to benefit. And that's why you see a lot of these industrial buildings taken off right now. Amazon, a lot of these companies that have the ability to just have an online business are benefit from it,
Oh,
and they all
huge.
need warehouse.
Huge. Like, it's something I don't know anything about, but you're absolutely right. Like, all the online businesses, I mean, there are people well, all the kids growing up now are watching young people who have these online businesses and, like, dreaming of becoming a YouTube star or, like, drop shipping or all these other, like, catchy things. But you're so right because the other thing, though, that is something to think about with the boutique hotels, and this is more of a con, is that it is like running an Airbnb, but those are much more high maintenance. Like, my 4-unit vacation rental is so much more maintenance
Oh,
than
it
my
is.
apartment building.
Yeah,
Because the furniture and honestly, sometimes I look, I'm like, "Who are these people? Who these people live like animals. What are you doing in here?" I never, like, damage things when I go somewhere. I have kids. They don't even do this stuff. So, there is, like, this thing that people need to think about, which is time. I don't think boutique hotel operation is a great thing to do if you're, like, have a full-time job in, like, corporate America working. Unless you have a really good manager. In my experience, having vacation rental managers was expensive. It was kinda like, why am I should just rent it as apartments if I'm gonna pay somebody 20 or 25% as a management fee. It kinda eats into all of your profits. So, not yes, boutique hotels are a great business, but it's not for the people who are looking for the easy 4-hour work week.
no,
Like,
it's not passive at all.
no, no.
Not passive at all. In terms of cap rates, what are you seeing right now with cap rates? Are you seeing them soften, especially like here in San Diego, for example?
I'm not seeing them soften enough, but they have softened a little bit. And also, even with cap rates not softening, rents going down has dropped prices. But I've heard recently somebody was saying, oh, Orange County is just like, it's like the market's really moving. Everybody's so busy. It's huge. But then I was hearing that they were buying apartment buildings at a 7 cap. And I'm like, here, if you bought it in a 7 cap, you're going to be in like a D market to get a 7 cap, like a true 7 cap. So I just think for whatever reason, San Diego's been slow to get to this point. So hopefully we'll see cap rates come up a little bit. But it's sort of a double-edged sword, right? If you're already an investor, you're like, damn, I hope they hold. Like, I don't want my assets going down in value. But I do think that we'll see some softening and because, like you said, these like tired landlords, they need to get out of the business. They're like, I just need to sell. So that is going to cause more comps. People are just getting worn down. You can only hold out so long, right?
Totally, totally. What did you mention about the ADU stuff? I know there's been some new regulatory rumors coming down the pipeline. What's the latest with the ADU stuff here in San Diego?
I haven't followed it much, to be honest. I'm speaking on a panel next week about the future of ADUs, so I should probably look at it. I know that there's some stuff I know that they're looking at the people who are building all these ADUs. I think it should only affect, like, the single families where people are adding all these units. Like, if you go to Claremont, for example, I'm doing one in Claremont where it's like a little 4-unit building. They're adding 12 units, you know? You're like, "Shit, that's a lot." So
Yeah.
if somebody lives there, that's their family home, they're pissed.
Oh,
And
totally. And there's no parking.
yeah, they have no parking, their cars are all over the street, so there was a meeting last week down at, like, city council or something I know a lot of, like, apartment brokers went to, but it sounds like this is coming to an end, like, it's not gonna be available much longer, they're gonna crack down on, like, the junior ADUs, it's not the 1 ADU, it's, like, the JDUs and all these other ones. I think apartments, it should stay, like, if you own an apartment building and it's in an area where there's other apartments, that
Yeah,
makes
urban
sense.
area, that's
But
walkable.
they're gonna have to make more rules, like, nobody wants this in their neighborhood where they live.
Agreed, agreed. Yeah, it's funny you mentioned Claremont. So a couple good friends of mine, they just sold their place in Claremont and moved to the East Coast, and they were like, "Hey, we're gonna list our home soon. Do you wanna buy it?" They're like, "It's already, like, approved for, you could do, like, 11, 12 units in the backyard." And, so I went over there to look at it, and they're like, "Yeah, our neighbor, like, 10 houses down just did the same project." And so I went over and drove by, and to your point, it just doesn't look right. It's a, a 1950s constructed neighborhood with a cul-de-sac, a lot of 3-bedroom, 2-bath homes, and then you see this big 12-unit apartment building in someone's backyard, and it just doesn't
It's
look
an
right. It looks so
eyesore.
weird, yeah.
Yeah.
And so I get it, and there's no parking. And I get it. If I was raising kids and a family in a cul-de-sac, I probably wouldn't want that either. So
And those
I
people talk
totally
the
get it.
loudest. They
They
do.
do. Oh, they do.
They talk
They
the
don't like
loudest.
Airbnbs either.
They hate Airbnbs, which is kind of funny because I think now that industry, it's really unfortunate, the thing with Airbnbs, because now there's so much technology with, like, the noise, like, they can see if you're making too much noise and make you calm down, like, cut it down.
Neighbors are still gonna hate it.
They can track how many devices are in an Airbnb if you're having a party or whatever. There's so many things, but they do hate it. Honestly, my neighborhood is, like, half vacation rentals, so I don't mind it, but, other people hate it. Where I live in La Jolla, like, the people think they own the place. Believe me, they talk the loudest.
No, I get it. I have a property in Scottsdale, and it's like we have signs across the street that say, like, homes, not hotels. And that property's been on the Fox 10 News. Like, it's just, I get it. And, like, that's why I said, like, as an Airbnb investor, like, you're never gonna feel good about what you do. Like, people are always gonna shun you, neighbors are always gonna be pissed. And that's how I'm like, I get it on both sides. But that's the one thing about investing in Airbnb is like you're never gonna truly feel good about what you're doing. Where on the boutique hotel side, it's like you're revitalizing an old property, making it nice. You're improving the aesthetics of the neighborhood, and people don't complain about hotels like they do these short-term rentals in their
Because they already
neighborhoods.
know. They
They
already
already know.
expect that. The
Yeah.
expectation's already set.
Hmm.
You know what I have seen done, though, recently is, and obviously you'd have to do this in a very specific zone, but there's a couple of guys out in, like, the desert who were building vacation rental home communities. And that is so smart, where you have your own community of, like, 6, 8, 10 homes, and they're all vacation rentals. And so you can rent them out to big parties, or you could do a mastermind there, or you could rent them out individually. And it's, like, all contained.
That's
So
pretty cool.
yeah, and I think that's a really cool idea too. I think there's definitely, like, space for that.
I like that. That is a pretty unique thing. So I wonder what the ADU, regulations may be pending, or maybe some of this more loose ADU regs going away. I wonder if it's an opportunity to kind of lock in a couple more deals and get some permits approved before this all happens.
Oh, for sure. I'd be running right now. If you're one of those investors, I'd be, like, hurrying to get all of your permits approved before things change. Because I think, just like everybody, there's always those people who get caught at the tail end. Like, even the Airbnb thing, everybody was going crazy during COVID. How many people were buying vacation rentals in Joshua Tree, for example, And I feel so bad for some of those people. They got, like, murdered on prices. So I think the same thing will happen with ADUs. Last cycle, it was condo conversions. So you just, like, don't want to be the last man out, because you're definitely going to get burned. So I think that's coming for the ADU people. Like, they just need to hurry up and get those projects approved, and probably look for another look for, where's the money going now,
They're going to have to find that next thing too,
Yes.
because there's been a lot of investors that have been capitalizing on it, especially locally. And so they're going to have to find a new thing. But I always thought, like, over the last 5 years, I'm like, you better take advantage of this program because who knows how long it's going to be around for.
For sure. That was never like something that could last a long time. And quite frankly, the regulations are so loose. Have you seen some of these units? I have a client. We're doing a refinance right now for an apartment. This one's up in LA, but somehow it's like a 2-bedroom that's 400 square feet. How do you get 2 bedrooms in a 400?
That is micro.
And to be honest with you, like, people brag about this stuff and they laugh about it, but lenders are not laughing about it. They're like, I don't know. So there's a lot of that happening where these units are really tiny. There's no parking, like all these things. And lenders are starting to get more conservative on those too.
Interesting.
Yeah.
Krystle, I appreciate you coming on the show. Always dropping a ton of value. Where can the folks get in touch with you if they want to learn more?
Yeah, you can go to Instagram. It's Krystle Rose Moore or Pacific Shore Capital. That's probably the easiest way to find me. I'm on the internet. I'm all things. You Google me, it'll probably pull up, but Instagram's the best way.
I can never get it right. Is it Simpson? Is it Moore?
Simpson. It took me 8 years to get there. That's probably why.
What's the Moore? That's your OG maiden last name? Okay, there it is. Well, anyways, hey, keep crushing. I'm a big fan of everything you're doing, and we're going to have to get Kenny back on here very soon. She's Krystle Simpson. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you guys in the next one. Peace.